Lucy, and I'm Amanda from BND. You may not have enough money saved to pay for large purchases like college, a car, or a home. That is generally when you apply for a loan, and it's important to realize that you'll pay more than if you had your own savings to pay for it. A loan is not free money, and it must be repaid.
The interest rate is the fee that you, as the borrower, pay to use someone else's money. There are two types of interest rates, fixed or variable. The fixed rate remains the same until your loan is repaid. The variable rate may go up and down depending upon the market rates.
When comparing loans, you'll want to look at the APR, or annual percentage rate. The APR in most cases will be different than the actual interest rate because it takes into consideration the interest rate plus any additional fees that you're charged for the loan. Additional fees may include loan origination fees, documentation fees, and administrative fees. The APR will show the yearly cost rather than the monthly cost and will give you a better idea of what the true amount of the loan will be.
Let's take a look at this scenario. You need $3,000 to buy a car. To figure out how much a $3,000 loan may cost you, you need to know three things. What's your interest rate? Are there any loan fees? And how long do you have to repay the loan, which is also known as the term of the loan? In this example, the loan has a fixed interest rate of 5%, a loan origination fee of 3%, and must be repaid within 36 months. Based on this information, the APR, or annual percentage rate, for this loan is 6.98%, which is more than the interest rate, and you would have to repay $3,334. Although it doesn't sound like much on a loan of this amount, it adds up pretty quickly when you pay fees.
Pay attention to the term of the loan, or length of time it takes to repay it. It's typically best to repay loans as quickly as possible so you can decrease the amount of interest you have to pay. If you have to take out a loan for a car, try to keep the term to 36 months or less. Cars can depreciate in value fast, and you don't want to end up owing more on the car than what it's worth. That's called being upside down on your loan.
So now you know what items you need to look at when comparing loans. There is one more item we want you to be aware of. When you apply for a loan, if you haven't established a credit rating or don't have a good rating because you haven't always paid your bills on time, you may be asked to get a cosigner. A cosigner is a person who promises to repay your loan if you don't. This happens a lot with student loans. If a bank gives you a loan for a car and you don't pay it, they can come and take the car away from you and resell it to pay the loan. With student loans, there is nothing to take back. So a cosigner may be required to guarantee someone will repay the loan. Visit Bank of North Dakota's College Handbook at collegehandbook.bnd.nd.gov to learn more about loans, credit cards, and other budgeting topics.